So for more on all of this, we're going to bring in Frances Stacy. She is the Director of Portfolio Strategy at Optimal Capital. Thank you so much for joining us. All right, so we're expecting a rate hike from the Federal Reserve. How will that impact regular Americans in the short term and the long term?
Okay, so regular Americans, we have to divide regular Americans, as we know, into two groups. We have to divide them into a group that has assets. I think, there's some talk this morning that if the Fed raises 75 bips, that the market's going to rally on that news. I don't know why that would occur necessarily. If they only raise 50 bips, the market would rally because now the expectations have been baked into the market that they're going to raise 75. But remember that, every time they raise interest rates, it puts pressure on corporate profits, and corporate profits are the things that ultimately determine, what the stock price is. So it's going to put more pressure on your portfolio if you have assets, and that includes 401ks, et cetera. Now, if you're one of those Americans that doesn't have assets, this really is much harder on you. Not only are you paying approximately 12% additionally with food, obviously, the gas prices are just at record highs. Now you are putting this stuff on credit cards, and every time the Federal Reserve raises rates, the cost of servicing that debt, your credit card interest rate is going to go up. And so it's going to get harder on you, too.
So wait a minute. Isn't there an upside like inflation? Isn't that the point of doing this, to bring inflation down?
It is the point. The problem is that everything that the Federal Reserve does has a lag effect, whether they are adjusting their balance sheet or whether they're raising rates. And what's happening now is inflation has taken off so far that the Fed is being tempted and almost baited into raising rates and tightening, well, definitely at a record pace. The problem with that is all of these lag effects from all of the things that they're doing aren't having a chance to work its way through the system. So let me give you an example. People whose, housing payments are going up, right? Those mortgages are due every month in most cases. So, those rates going up, it's going to take 30, 60, 90 days to see how many foreclosures are coming because people with adjustable mortgage rates can't make those payments anymore. And so that's the issue with doing so many moves all at one time.
Then if you see interest rates go up and they're forecasting that by the end of the year, the federal funds rate which determines borrowing between banks, could almost be twice as high as pre-pandemic levels. Does that mean maybe more money in your savings account, or is the difference negligible?
Well, exactly correct. I think that any increased interest you would get in your savings account is probably going to be wiped out either by the losses you're seeing in your 401k and other assets, the losses you're seeing in your housing prices, which they will go down, and or what you're paying additionally at the pump and elsewhere in inflation. And bringing down inflation is a good thing, but I will say, as bad as this inflation is, and I don't want to underestimate how bad it is, a credit crisis like 2008 will be much, much worse. And that would be the hard landing scenario. So we have a record amount of debt in the system. And every time one of these tightening things occurs, you're actually lessening the money in circulation available to pay and service that debt. And because those things have lag effects, it's hard to measure that in real time. And so the faster we tighten, the more room for a policy error. And that's what concerns me.
So I got to ask you about one more thing. As we've watched, the stock market plummet, the same or cryptocurrency went in the same direction. I mean, I remember when Bitcoin was, I think, 60,000. Last time I looked, at least yesterday, it was 22. Who knows where it is right now? And I'm wondering, what does that mean for crypto investors, or what does that mean for crypto in general? Or can we read too much into this?
So as it stands right now, crypto is almost, it's pretty well correlated, meaning it goes up and down with tech stocks. And when you raise these rates, you're increasing the borrowing costs for those tech companies, and the valuations have come down tremendously, but rate increases are harder on tech companies, which is why the NASDAQ is sold off more relative to the S&P 500. And so as these rate increases continue to put pressure on the tech sector, I assume it will continue to put pressure on crypto. In addition, with crypto, you've got regulatory risk. The more money people lose in crypto, and it went from a $3 trillion market to less than $1 trillion, the more regulators are going to come in and, depress crypto. The future eventuality for crypto they've made it into a commodity. It doesn't have intrinsic value. So it just means it's a place to put things when there's more money in the system. But as the money in the system gets reduced, all of these kind of bubble type assets are going to go down. If you own crypto, it depends. Did you put your life savings in it? Did you put a few $1,000s in it for, just for fun? If you put money in it just for fun, ride the ride. If you have a meaningful amount of money that is going to make a meaningful difference in your life, you might want to consider reallocating that to something else. And I will tell you, there will be a bottom probably in crypto, as always in all markets, but it's probably not going to be until the Fed pivots to a dovish position, and that's obviously not happening today. And that's probably also true for tech stocks. I still expect the NASDAQ to test 10,000.
Interesting. Frances, thank you very much.